Hey there, my name is Doug Waldman. I'm the Home Select Avant at Geneva Financial, and this video is about how to utilize the Home Select simulator tool to figure out if this is the right loan product for you. It's not for everyone. You may not qualify, but for those who do, the benefits are often staggering in scope. So let's dig right in. So you're going to go to gohomeselect.com or homeselectchallenge.com. Go down to the bottom of the page, go to the simulator. You're going to get started. The first thing you're going to do is start a new simulation. You're going to click go. Then you're going to go to the setup. The setup is you're a primary residence most likely, unless it's a second home or investment property. Put in your numbers accordingly. We're going to compare an all-in-one Home Select product versus a traditional 30-year mortgage. And we're going to say that our all-in-one loan is going to adjust monthly, which is what everyone is utilizing right now because we expect rates to drop. So we want this to adjust as much as possible as rates decline. We want to ride that all the way down to the bottom. Once you do that, you can certainly then lock in on a 3-year or 5-year locked-in rate. The average client pays this loan off in 7 to 12 years. So rate is not really that monstrous of a variable compared to the velocity at which we pay the loan off. So we're going to assume for this scenario, the guy or gal's got a $1.2 million house, $800,000 loan. This could be cash out, or this could be a rate and term, doesn't really matter. Let's say we're comparing it against a 6.75 conforming or jumbo rate, whatever. That's probably pretty low. Most people are going to be probably paying some points to get to 675, but that's where we'll start for right now. Next page, we're going to look at what is going through their deposits. These are net deposits. This is not your gross paycheck. This is how much is hitting your bank account. So if you get paid, let's say there's $8,000 a month or $8,000 a week getting paid, and you're taking out your employment taxes, you're taking out your 401k, maybe your health insurance. So $6,000 is what's landing in your account. Roughly $26,000 in deposits and roughly $312,000 annual. Next page is now we want to know what you're left with. This again is for conservative borrowers. This is for people that have more money left over than they have month. If you're living hand to mouth, this probably isn't the right mortgage for you. This is for people with good credit, sophisticated understanding of how money works, are interested in sheltering as much interest expense as possible and getting their mortgage paid off as quickly as possible so they can put their money into better performing assets. And if you know anything about real estate, the house you live in is not a performing asset typically. It's non-performing because you're making the payment, not a tenant. So we want to get the interest paid on non-income producing assets, and especially in assets that go down in value, like a car. Anything that has depreciating values, we want to get those things paid off as quickly as possible. You don't want to pay interest on something that's dropping value on top of that, right? So comparison loan, we're looking at the payment on the 675 would be roughly $5,200. We're estimating ballpark $1,500 a month in insurances and taxes. This is always, in the mortgage world, is always turned into a monthly number, even if you pay that every 6 months. And then we're going to say that you have roughly $10,000 that you're spending on top of your $16,000 or your $6,000. Sorry, you're going to spend another $10,000 on cars, private schools, food, entertainment, ski vacations, whatever it might be. That you're going to keep roughly 35% of your net income in your bank account. You're either going to keep it in your checking, move it over to your savings, aggregate it to pay bigger debts like tax bills, put money aside for big vacations, kids, college, etc. So you're keeping roughly 35% of your net. And we're going to calculate results. It's that simple. This scenario, this person is going to pay off their loan in 6 years versus 30. They're going to pay a total interest expense of $232, under $250,000 versus over $1 million in the 30-year mortgage. Do I have your attention? We're saving this client $800,000+, and they're paid off in 6 years. There's some other interesting tabs down here for you to play with. The pay down summary will show you that the comparison APR on this particular scenario is 1.74 versus 6.75. That difference is staggering, right? We're paying off nearly $11,000 in principal a month versus only $2,200, and we're only paying 29% of the loan amount in interest expense versus the normal mortgage, you're going to pay 133%. And for this loan not to pencil, interest rates would have to climb to nearly 19%. So again, there are lots of other things you can play with in here. This is an interesting one. This is wealth accumulation. So we can assume that this person is going to pay off their loan in 74 months, and then we want to know how long after that will they keep on investing. Maybe they're going to retire, right? So we're going to drop this down 74 months. Let's say they work for another 15 years, another 180 months. So we'll take this down to 254, which would be the 74 plus 180. Right? So we're going to take this down to 254. So for another 18 or 180 months after they pay off the house, they will keep on saving money, and they have $14,000 to spend. Let's say they take 10 of that and they invest it. Okay? And let's say the average return on investment, I don't know, is maybe 5% is what this thing auto-populates. We know that in good markets like in California, houses are consistently appreciating for at least 5%. Or thereabout. We can update the results, and look what happens to the client that's using the all-in-one at the end of the time period, which is the 74 months to pay off the loan plus the another 15 years in saving and aggregating wealth. Our client has $6 million net worth on just those two vehicles, interest or their house and their investment portfolio, versus 3.370. So over $2 million more wealth accumulation by utilizing this tool. Powerful. Reach out to me. Doug Waldman, Geneva Financial, 805-231-1644. Let's make sure you're getting meaningful results from the simulation, and let's figure out what we can do to increase your wealth and decrease your interest expense, because that is legacy money. That is money that you can use to increase lifestyle, leave money for your kids, create a charitable foundation, buy a yacht, whatever you want to do, it's your money, but why give it to the banks if you don't need to? Doug Waldman, Geneva Financial. Thanks for watching.